Welcome to this explainer. Today, we're uncovering the hidden costs of inflation that absolutely no one talks about. Sure, we hear the word inflation all over the news, but those headline numbers, they're really only telling us half the story. We're going to break down exactly how macroeconomic forces silently erode your purchasing power in ways you might not even realize, and, much more importantly, what you can actually do to protect your wealth.
Okay, let's dive into this. Is your cash actually safe? So many of us are taught from day one that hoarding cash in a bank account is the ultimate responsible way to protect our money. I mean, it feels totally safe, right? It doesn't bounce around like the stock market. You log into your app and boom, same exact number looking back at you every single day. But honestly, that feeling of safety is a complete illusion.
Picture this. Let's say you're earning a 4% yield on your savings. That's your nominal yield, basically the number stamped right on your bank statement. And hey, according to research from Eco3Men, it looks fantastic on paper. But wait, if inflation is running at 5% a year, your real yield, your true inflation-adjusted return, is actually negative 1%. So while your balance technically grows, your actual purchasing power is shrinking. You're literally losing wealth while watching your bank balance go up. Here is a stark reality check for you from Darling Wealth Management. If inflation averages just 3% a year, and by the way, historically, that is incredibly normal, $100 today is only going to buy you $41 worth of goods 30 years from now. That is the silent reality of just letting your cash sit idle. It might feel super secure emotionally, but financially, it's just getting weaker and weaker every single day. Section 1, real versus nominal rates, the true cost. To actually protect ourselves, we really need to grasp the math behind this hidden wealth erosion. There's this absolutely brilliant insight from Eco3Men that hits the nail on the head. Nominal rates are the story the system tells you. Real rates are what actually happens to your money. Central banks, huge institutions, they all think in real terms. But everyday savers like us, we often make this huge, costly mistake of just staring at those nominal numbers. If you only listen to the story, you're completely missing the reality of what's happening to your wallet. Let's look at how the economic regime has shifted over time. From 1980 all the way to 2000, savers were actually getting compensated. Real rates averaged a solid positive 3.5%. But then, jump forward to the 2009 to 2021 era, real rates were mostly negative. And then it got even crazier. From July 2020 to May 2023, we hit a massive 35-month streak of negative real rates. During that time, holding cash wasn't an asset at all. It was literally a liability, dragging you down with an invisible tax of 3 to 5% every single year. Section 2, the invisible wealth thieves, silent erosion. So now that we've got the math down, let's pivot a bit. Think of inflation not just as some big, abstract economic concept, but as a sneaky pickpocket. And the first trick up their sleeve is shrinkflation. This is when a product shrinks in size or quantity, but surprise, surprise, you're still paying the exact same price. Companies use shrinkflation to cover their own rising production costs while protecting their profit margins. They're basically betting on the psychological fact that you and I will notice a price hike way faster than we'll notice a slightly smaller cereal box or a few missing sheets on a roll of paper towels. But wait, there is an even stealthier thief out there, skimpflation. This is a flat-out degradation in the quality of services or ingredients, all while keeping the price exactly the same. Maybe your go-to mayonnaise brand secretly drops its expensive egg yolk content from 9% down to 6%. Or maybe a nice hotel just quietly stops offering daily housekeeping. Because they aren't actually changing the package size or the weight, skinflation often completely slips under the radar of official government inflation measurements. It's totally invisible on paper. And guess what? The government gets in on the action too, through something called tax bracket creep. Research from the University of the Free State shows exactly how this works. Let's say inflation pushes your nominal wages up. You get a nice cost of living raise. Sounds amazing, right? Well, that raise actually pushes you into a higher tax bracket. So now you're paying a larger chunk of your income in taxes, even though your real purchasing power hasn't grown one single bit. You're running on a treadmill just to stand still. So the crucial point is that this creates what economists call a fiscal drag. Because you've been nudged into that higher tax bracket, the government is raking in a disproportionate amount of taxes, which leaves you, the taxpayer, essentially poorer. This whole process ends up dampening consumer spending across the entire economy because our disposable income is just being silently siphoned away. And the crazy part, it happens without a single new tax law ever being passed. Section 3, the nightmare of stagflation, the ultimate threat.
Now let's escalate this explainer to the ultimate macroeconomic boss level.
This is a scenario that literally terrifies economists and can absolutely wreck traditional investment strategies. We're talking about stagflation. Makita Investment Group defines stagflation as this toxic mix of high inflation combined with stagnant or even declining economic growth and rising unemployment. Normally, you only get inflation when the economy is booming, right? Stagflation totally defies that. It creates this agonizingly high misery index for regular households because everything costs way more. But at the same time, jobs are incredibly scarce and wages are just flatlining.
And this brilliantly illustrates why stagflation is such a nightmare for your portfolio. Historical data from Makita shows it acts like an absolute wrecking ball. When you have high inflation and low growth, almost all of your traditional public equities and bonds get hit with simultaneous bear markets. There is virtually nowhere to hide in a standard portfolio.
Let's break down exactly why the classic 60-40 portfolio, 60% stocks, 40% bonds, completely fails here. It's a double whammy. On one hand, slowing economic growth crushes corporate earnings, which sends stock valuations plummeting. On the flip side, rising inflation aggressively eats away at the real value of the fixed payments you're relying on from your bonds. It is, quite literally, the worst of both worlds. Section 4, How to Protect Yourself, Building Resilience. Okay, take a deep breath. We aren't just here to doom scroll the economy. Let's shift over to the solution phase of this explainer. We've actually got a proven playbook of assets that can act as serious armor against all these hidden costs. Makita's research outlines some fantastic defensive assets that inherently tie their returns to rising inflation. First up, TIPS, that's Treasury Inflation Protected Securities. Their principal actually adjusts upward right alongside the Consumer Price Index. Then you have real estate. As inflation goes up, property values and rental cash flows tend to naturally rise with it. And finally, commodities. These are direct hedge because they literally are the raw materials. So when supply shocks drive inflation up, commodities are the things gaining value. Check out this data from Goldman Sachs highlighting the impact of just a 1% surprise jump in inflation. When inflation spikes out of nowhere, stocks historically drop about 3%, and bonds bleed 4%. But commodities, they historically generate a massive 7% gain in real returns. They're actually one of the very few asset classes out there that truly thrive when inflation sends a shock through the system. Now, what's really interesting about this is Goldman Sachs is currently forecasting that gold could reach $2,700 an ounce. Gold has this long, deeply established history of being the ultimate safe haven, and not just against inflation, but against geopolitical risks and moments when central banks start losing their credibility. When the whole system starts shaking, gold tends to stand incredibly firm. Now, if you are sticking with stocks, you absolutely have to look for one specific superpower: corporate pricing power. Baker Tilly points out that this is simply a company's ability to pass their increased costs right down to the consumer without taking a hit to their own profit margins. You usually find this in non-discretionary sectors. Think healthcare or consumer staples. People literally have to buy their medicine and groceries no matter what the price tag says. That gives these companies immense insulation against inflation. Let's move to and see how this builds into an actual actionable plan. Darling Wealth Management laid out these super practical steps so everyday savers can actually stop treading water. Step 1, keep only your absolutely essential cash, like 3 to 6 months of living expenses for emergencies. Everything else, get it off the sidelines. Step 2, invest consistently. We all know time in the market beats trying to time the market. And step 3, match your strategy to your time horizon. You have to make sure your long-term money is parked in assets that have the power to actually outpace inflation. I want to wrap up our explainer today by leaving you with a bit of a proactive homework assignment. I want you to really challenge your own financial plan and ask yourself, am I holding way too much cash right now? Are my investments actually positioned to survive shrinkflation, skimflation, and even the threat of stagflation? Am I investing enough right this second to truly stay ahead of rising costs over the next 30 years? It's a heavy question for sure, but honestly, answering it is the absolute key to protecting your wealth. Thank you so much for joining me today, and as always, keep learning.